Unlock tax benefits in one big beautiful bill. Tips for Americans. Picture this: a massive tax overhaul that's like a gift that keeps on giving, potentially putting thousands of dollars back into the pockets of everyday Americans. That's the buzz around the One Big Beautiful Bill, which rolled out earlier this summer, and experts are urging people to start thinking about it now, even though tax season feels miles away. While you've probably heard about the splashy perks like no taxes on tips or overtime pay, and that $6,000 bonus deduction aimed at seniors, there's a whole lot more tucked into this bill that could reshape how you handle your finances. Things like deductions for charitable giving, tax breaks on car loans, and bigger credits for families are changing the game, offering new ways to save money no matter if you're itemizing your deductions or not. But here's where it gets exciting, and a bit more accessible for those who usually skip the itemized route. Take charitable contributions, for instance. Under the old rules from the 2017 Tax Cuts and Jobs Act, if you opted for the standard deduction, you were basically out of luck when it came to writing off your donations. That changed temporarily during the pandemic thanks to the CARES Act, which let individuals claim up to $300 and married couples up to $600 for cash gifts in 2020 and 2021. But those breaks vanished after that, leaving many feeling shortchanged. Now, with the One Big Beautiful Bill making this permanent starting in 2026, anyone can snag a deduction of $1,000 per person, or $2,000 for couples filing jointly, even if you're not itemizing. This is what's called an above-the-line deduction, which means it reduces your adjusted gross income, AGI, before you even get to the deduction phase. Think of AGI as your total income minus certain subtractions. Lowering it can cut your tax bill, and might even open doors to other tax perks you didn't qualify for before. For example, if you're someone who donates to a local food bank or your alma mater at the end of the year, this could mean real savings. Say you give $1,500 in cash, and now you can deduct part of it directly, potentially shaving off a few $100s from your taxes. And this is the part most people miss. While these changes sound straightforward, there are nuances that could stir up debate. Shifting to the auto loan interest deduction, which is a fresh addition under this bill. For the first time since the Tax Reform Act of 1986 wiped it out, you can now deduct up to $10,000 in interest on personal auto loans. And it's available even if you're not itemizing, kicking in from 2025 through 2028. But hold on, because not everyone's going to waltz into this benefit. You've got to buy a new vehicle that's assembled in the US, use it for personal purposes, and meet certain income caps, things that might exclude a lot of folks, or push them toward specific car choices. Imagine you're in the market for a new car. Under these rules, deducting interest could make buying more appealing than leasing, especially if you're in a lower tax bracket. A tax pro might point out that this could encourage more domestic car sales, but critics could argue it favors wealthier buyers who can afford new cars, potentially widening economic gaps. Brian Schultz, a certified public accountant, notes that this deduction could alter your financial calculations, like weighing the total cost of ownership against tax savings. Now, let's talk families, because there are some solid wins here too, and they are designed to ease the burden for parents and caregivers. Even if you're sticking with the standard deduction, two key updates stand out. First, there's the Dependent Care Flexible Spending Account, DCFSA. This is a handy setup where you set aside pre-tax dollars from your paycheck to cover costs like daycare or care for an elderly relative. The One Big Beautiful Bill bumps up the annual limit to $7,500 for most filers, or $3,750 if you're married and filing separately, starting next year, a jump from the long-standing $5,000 cap that hadn't budged in decades, except for a temporary hike to $10,500 during the COVID era. Enrollment for these accounts often happens during open seasons, so if your employer offers one, it's worth checking in soon. For instance, if you have a toddler in daycare costing $8,000 a year, maxing out your DCFSA could save you hundreds in taxes by reducing your taxable income upfront. The second family-focused change is a major upgrade to the Child and Dependent Care Credit, CDCC. Beginning in 2026, this credit gets a double whammy. The rate jumps to 50% from 35% for qualifying expenses, with caps at $3,000 for one child and $6,000 for two or more. But it phases down as your income grows. Plus, the income threshold for getting the best rate has been raised significantly. Now it's $206,000 for married couples filing jointly and $103,000 for single filers, up from previous levels. That means more families could see a bigger credit. According to the First 5 Years Fund, nearly 4 million households might benefit, with some seeing an extra $900 in their pockets. Sarah Rittling from the organization highlighted how this could be a game changer for parents juggling tight budgets. And with some savvy planning, like increasing your 401k contributions to lower your taxable income, you might even qualify for a larger credit. But this is where it could get controversial. While these expansions sound great, some might worry that raising income thresholds benefits higher earners more, potentially diverting resources from those who need it most. Brian Schultz reminds us to keep an eye on those income phase-outs, as they can be tricky. All in all, with these updates, tax planning is becoming a bigger deal for everyone, not just the number crunchers. But let's not gloss over the debates. Is this bill truly helping the average Joe, or is it skewed towards certain groups? What do you think? Will these changes make a real difference in your finances, or are there aspects that seem unfair? Share your thoughts in the comments. I'd love to hear if you're excited about these opportunities, or if you see potential pitfalls. Trump's Big Beautiful Bill 2025 tax changes for you. Trump's Big Beautiful Bill has introduced significant tax modifications for 2025, and here's what you need to know about how they could affect you. On July 3, 2025, Speaker of the House Mike Johnson, Republican Louisiana, officially signed the One Big Beautiful Bill Act during a ceremony attended by fellow Republicans in the Rayburn Room at the U.S. Capitol in Washington, D.C. It's been roughly 2 weeks since President Donald Trump's ambitious legislation, often referred to as the Big Beautiful Bill, was enacted. Financial advisors and tax experts are still working to fully understand the implications of this sweeping law for their clients. Several of the changes outlined in the bill will take effect in 2025, which means they will influence tax returns that are filed in 2026. While the Trump administration has been advocating for working family tax cuts, the actual impact of the legislation can vary greatly depending on individual circumstances. Some of the updates are quite intricate, according to experts in the field. There are just so many moving pieces, remarked Jim Garino, a certified financial planner and managing director at Baker Newman Noyes in Woburn, Massachusetts. He is also a certified public accountant. #### key changes to anticipate for 2025. As financial advisors analyze the new provisions, many are running projections over multiple years to assess how these changes could affect taxes. Without careful income planning, individuals might inadvertently reduce or even forfeit various tax benefits for which they would otherwise qualify. Garino emphasizes that in tax strategy, you never want to do anything in a silo. Here are some of the most important changes from Trump's legislation that you should be aware of for 2025, along with their potential effects on your taxes. ### extensions of Trump's 2017 tax cuts. The Republicans' flagship legislation has made Trump's 2017 tax cuts permanent. This includes lower tax brackets and increased standard deductions, among other provisions, which have generally resulted in reduced taxes for many Americans. Without this extension, most taxpayers could have faced higher taxes in 2026, as highlighted in a 2024 report from the Tax Foundation. However, the new law not only maintains Trump's 2017 cuts, but also introduces additional tax breaks starting in 2025. The standard deduction will rise from $15,000 to $15,750 for single filers, and from $30,000 to $31,500 for those married filing jointly. The child tax credit will see an increase, with the maximum benefit going from $2,000 to $2,200 per child. For those who itemize their deductions, there will also be a temporary increase in the cap for the state and local tax deduction (SALT). In 2025, the SALT deduction limit will be $40,000, a significant jump from the previous $10,000 limit. However, this enhanced SALT benefit will phase out for incomes between $500,000 and $600,000, potentially leading to an artificially inflated tax rate of 45.5%, a phenomenon some experts have dubbed the SALT torpedo. This creates a sweet spot for the SALT deduction for those earning between $200,000 and $500,000, as noted by CPA John McCarthy in a recent blog post. New tax changes introduced for 2025. The tax and spending bill also brings forth some temporary tax breaks that will be effective in 2025. Many of these provisions were proposed during Trump's 2024 presidential campaign. Notably, there is a $6,000 bonus deduction for certain older Americans aged 65 and above, which will phase out for single filers earning over $75,000 or married couples filing jointly earning over $150,000. Additionally, new deductions will be available for tip income, overtime earnings, and car loan interest, each with specific eligibility criteria. The return of the premium tax credit subsidy cliff. During the pandemic, Congress had temporarily increased the premium tax credit, making marketplace health insurance more affordable through 2025. However, Trump's legislation did not extend this enhanced tax break, which could lead to increased Affordable Care Act premiums for over 22 million enrollees if no further action is taken, according to KFF, a health policy organization. This change could significantly affect enrollees as they select ACA health plans this fall, warns Tommy Lucas, a CFP, an enrolled agent at Moissan Fitzgerald Tamayo in Orlando, Florida. Starting in 2026, enrollees will need to brace for the ACA subsidy cliff, where they will lose the premium tax credit if their income exceeds the earnings thresholds by even a single dollar. Currently, most ACA enrollees receive at least a portion of the premium tax credit. However, the subsidy cliff means that once earnings surpass 400% of the federal poverty limit, enrollees will lose this benefit. For 2025, that threshold is set at $103,280 for a family of 3, according to the Peterson Center on Healthcare and KFF. Conclusion. As these changes unfold, it's crucial to stay informed and consider how they may impact your financial situation. What are your thoughts on these tax changes? Do you believe they will benefit working families, or do you see potential pitfalls? Share your opinions in the comments below.